we'll just address Equitas Small Finance Bank's numbers because they have already come out with their numbers. But let's understand more about where they are projecting for the numbers to go ahead and also the growth. We've got PN Vasudevan, who is the MD and CEO at Equitas Small Finance Bank, joining us. A very good morning to you, sir. Thank you so much for joining us in ET now. Firstly, let's talk about the asset quality. There has been an increase in the NPAs. You have slippages also that has spiked up. Flood was one of the reasons, but apart from that, we also saw an uptick in your NPAs in the microfinance business. Are you envisaging any stress building up for the coming quarters as well in that particular segment?
See, actually, our normal levels of NPA pre-COVID has been around the 2.5% level. And in second quarter, first quarter, it was just about 2.6. In the second quarter, we actually did one ARC sale. And because of that, the NPA had come down to 2.12%. In the third quarter, the NPA normalized a little bit. It went to 2.29%. If you include the securitized book on the gross asset basis, our NPA has gone up to 2.29%, which I think are fairly well under control, especially compared to our pre-COVID normal levels of 2.5%. We believe that our NPA is quite under control. There was some amount of rains, excess rains during the last quarter, especially in South and Tamil Nadu. That did have some impact on the collections, but that is very seasonal and it keeps happening all the time. So that is not something that is new to us or something that we are experiencing for the first time. So the seasonal rains and seasonal impacts are something very normal. And but our overall NPA remains within our comfort zones of the pre-COVID levels of around 2.5%.
All right. Good morning, Mr. Vasudevan. This is Shrishti also joining in. If we look at your credit cost guidance, then that is at 1.25%. Again, a little higher than the current levels. So do you look at it as a conservative target, or should the investors expect any stress from other pockets of your book?
I think we have guided 1.25 in the beginning of the year. And so one can presume or work within that range. As I mentioned, the actual credit cost in the first 9 months is much lower. And so we should hopefully end up at a level which is less than 1.25 for the full year, even though we had guided 1.25 in the beginning of the year.
All right, let's also talk about the loan growth then, as guided between 25 to 28%. If I look at your actually housing finance book, its proportion is up from about 7% in Q3 FY20 to about 12% of AUM in the current quarter. That's the now quarter that you reported your numbers. Is it a strategic move to increase the share in the housing finance in AUM?
So overall, our advances growth has been around 32% for the first 9 months. And yes, we have guided for a 25 to 28% growth for the full year because we do have a larger base effect in the last quarter of last year. And so we do expect that even though the growth should be strong, but percentage might come down because of the base effect. Within the advances portfolio, if you see, our small business loan is the largest, which is around 37%. Then vehicle finance follows that, which is around 25%, and microfinance, which is about 18%. So these are all kind of mature portfolios. They have been there for a long time in the company now, and so they're kind of maintaining their contribution levels. Affordable housing finance is something we just started recently, maybe about 3 years back. So it's still at a very nascent and growth stage. And so you would see that the disbursement and advances growth of affordable housing will be larger than the overall bank's credit growth. And that's why you see the contribution of affordable housing going up. Currently, affordable housing is about 10% of the total advances book of the bank. And we expect that over a 5-year period, I mean, I'm talking of a little bit longer term, 5-year period, we should be looking at affordable housing contributing almost around 15%.
All right, Mr. Vasudevan, if your NIM target for FY24 is at 8.5% and possible exit at 8.25% on the lower side. So between these two, do you see any levers for NIMs to move more towards the upper end of the guidance in Q4?
Yeah. So as far as the NIMs are concerned, in the beginning of the year, we had mentioned that our exit NIM for the fourth quarter could be around the 8.25% level. And the NIM for the overall year, the full year, could be around 8.5%. That's what we had kind of, expected and guided in the beginning of the year. And I think we are fairly playing close to whatever we had guided. The NIM for the third quarter, exit third quarter was 8.36%. It might drop down by another few more basis points in the fourth quarter, so that 8.25 or just around that is something very, very, very likely. And the overall NIM for the 9 months so far has been around 8.56%. So it might marginally drop to that 8.5. So I think what we guided in the beginning of the year is really playing out more or less in line with our expectations. And so, as I mentioned, if the interest rates remain where they are today and do not really go any further up, then we might see over the next 3-4 quarters, we might see a reversal of the effect that we have been seeing for the last 1 year.
Right. And lastly, Mr. Vasudevan, let's talk about your CASA ratio. If you could tell us about your bank particularly, given that the industry is actually seeing a downtick in CASA, how do you actually see this actually reflecting or auguring for your bank?
Okay, so as far as the CASA is concerned, yes, for the first time in the third quarter, we are able to hold our CASA percentage. It has been coming down steadily over the last 4 or 5 quarters. We were at a peak of 51% at some point in time long back, and it had been coming down. For the third quarter of this year, finally, we have managed to hold the CASA percentage at the same 33% level as the previous quarter. And one more very important thing that I would like to highlight is the fact that out of the total incremental deposits that we got over the third quarter, whatever the additional deposit that we got in the third quarter to fund the bank's growth, almost 80%, I think 78 or 79% of that incremental deposit is from retail deposits. So it's not bulk. We have been able to significantly improve our retail deposit mobilization, and almost 78-79% of all our incremental deposit, which is helping to fund the growth of the bank, has actually been coming from the retail deposit. So I think that's something that we feel very comfortable with.
All right, with this, we'll let you go on that. Thank you so much, Mr. Vasudevan, for joining us today and helping with the growth outlook for the bank in the times ahead.